A $24 million metaverse plot just sold for $9,000. That's not a typo, we're talking about a 99.9% collapse in value. If you've been following the metaverse hype or you're wondering whether virtual real estate is dead, this story is going to blow your mind. Welcome back to the channel where we cut through the crypto noise and give you the real story. I am your host, and today we're diving deep into what might be the most spectacular collapse in digital asset history. We're going to break down exactly what happened, why this isn't an isolated incident, and most importantly, what this means for your investment strategy going forward. Let me paint you a picture. Back in 2021, at the height of the metaverse mania, virtual land in platforms like Decentraland and The Sandbox was selling for millions. Companies were rushing to buy digital real estate, celebrities were hosting virtual concerts, and everyone was convinced we were witnessing the birth of a new economy. This particular plot we're talking about was in a premium location, think Times Square of the metaverse. The buyer paid $24 million, convinced they were getting in early on the next big thing. Fast forward to today, and that same plot just changed hands for $9,000. That's a loss of $23.99 million. But here's what makes this story even more shocking, this isn't happening in isolation. According to data from DappRadar, the average price of virtual land across major metaverse platforms has dropped by over 95% from peak prices. We're seeing plots that sold for six figures now going for the price of a used car. So what exactly happened here? Well, it's a perfect storm of overhype, market reality, and changing consumer behavior. First, let us talk about the fundamental problem with virtual land as an investment. Unlike physical real estate, virtual land has no scarcity beyond artificial constraints created by platform developers. If Decentraland decides tomorrow to expand their map and create more land, your premium location suddenly isn't so premium anymore. Second, the utility problem. The promise was that these virtual worlds would become bustling centers of commerce and social interaction. The reality? Most metaverse platforms are ghost towns. Decentraland, one of the largest platforms, reportedly has fewer than 30 daily active users despite having a market cap in the hundreds of millions. If you're finding this valuable, smash that like button, it helps more people see this analysis. Third, we had a massive speculative bubble. When Facebook rebranded to Meta and started pumping billions into virtual reality, everyone wanted in on the action. Investment funds, celebrities, even major corporations started buying virtual real estate not because they had a use for it, but because they thought someone else would pay more for it later. This is classic greater fool theory in action. And like all bubbles, it eventually ran out of greater fools. Now, let us look at some hard data that shows just how dramatic this collapse has been. In November 2021, the total value of virtual land sales across all platforms hit $470 million. By November 2023, that number had dropped to just $15 million. But it's not just about the money, it's about what this tells us about the state of Web3 and digital assets more broadly. The metaverse was supposed to be one of the foundational use cases for NFTs and blockchain technology. Its spectacular failure raises serious questions about the sustainability of many blockchain-based projects. Here's where it gets really interesting from a market psychology perspective. The same venture capital firms and institutional investors who were pumping millions into metaverse projects are now quietly writing off their investments. Reports suggest that some of the biggest names in Silicon Valley have lost hundreds of millions on virtual real estate bets. Fun fact, 80% of you watching aren't subscribed yet. If you want to stay ahead of the market and avoid these kinds of traps, fix that now. So what does this metaverse collapse mean for the broader crypto and digital asset market? Well, there are several key implications we need to discuss. First, this is a massive credibility hit for the entire Web3 space. When mainstream media covers crypto, they're not going to focus on the technical innovations or the potential for decentralized finance. They're going to talk about how people lost millions on virtual land that's now worthless. Second, it's highlighting a fundamental problem with many blockchain projects, they're solutions looking for problems rather than solving real user needs. The metaverse platforms built these elaborate virtual worlds, but they never figured out why people would actually want to spend time there. Third, this collapse is part of a broader pattern we're seeing across speculative tech investments. From SPACs to growth stocks to crypto, anything that was priced for perfection based on future promises rather than current reality has been getting crushed. But here's what's really important for you as an investor or someone interested in this space: this doesn't mean that all blockchain technology or digital assets are worthless. What it means is that we need to be much more discerning about separating real utility from pure speculation. Let me give you a framework for thinking about this. When you're re-evaluating any digital asset or blockchain project, ask yourself 3 questions. First, does this solve a real problem that people are willing to pay to solve? Not a hypothetical future problem, but something that exists right now. Second, does this actually need blockchain technology, or could it be done better with traditional technology? A lot of projects add blockchain just to ride the hype wave. Third, are people using this today for its intended purpose, or are they just buying it hoping to sell it to someone else later? If it's the latter, you're probably looking at a speculative bubble. The metaverse land craze failed all 3 of these tests spectacularly. It didn't solve a real problem, it didn't need blockchain technology to work, and 99% of buyers were pure speculators. Now, here's my actionable advice for navigating this market environment. First, if you're reholding metaverse-related assets, it's time for some serious portfolio analysis. Look at each holding and honestly assess whether there's any fundamental value there or if you're just hoping for a miracle recovery. Second, use this as a learning experience about market cycles and hype. The next big thing that everyone's talking about might not be the next big thing at all. Always do your own research and never invest more than you can afford to lose in speculative assets. Third, focus on projects and assets that have real adoption and real utility today. Bitcoin, despite all its volatility, is actually being used as a store of value and payment system. Ethereum is hosting billions in DeFi transactions. These have proven use cases beyond speculation. Finally, remember that markets are cyclical. The metaverse hype cycle is ending, but that doesn't mean there won't be legitimate virtual world applications in the future. The key is waiting for real utility and adoption rather than buying into hype. The metaverse collapse is a cautionary tale about the dangers of speculative investing and the importance of fundamental analysis. But it's also a reminder that in emerging technology markets, separating signal from noise is one of the most valuable skills you can develop. Drop your prediction in the comments. Do you think virtual real estate will ever recover, or is this the end of the metaverse dream? I read every single one. And subscribe if you want to be early on the next market move instead of getting caught holding the bag. Before you go, make sure to check out this next video where I break down the 3 crypto projects that are actually solving real problems and seeing real adoption in 2024. It's a much more optimistic take on where this technology is heading. The metaverse bubble has burst, but the lessons we can learn from it are invaluable for any investor in emerging technologies. Stay smart, stay skeptical, and I'll see you in the next one.